Hello, my name is Tom Coughlan and I'm a Financial Planning Manager at Scottish Widows, providing technical support on pension legislation and taxation. In this edition of the Scottish Widows Expert Series vodcast, I'm going to explain some key points about employer pension contributions. I'll start by looking at the criteria that must be met and the limits that need to be observed. I will then move on to some of the more practical aspects. Employer pension contributions are a key component of many employees' benefit packages. As a result, they will usually figure heavily in any retirement planning advice. We'll start with an overview of how to determine the value of an employer contribution. The contribution can be explicit. In other words, it may be paid direct to the defined contribution scheme that the employee is a member of, or it can form part of the funding of a defined benefit scheme that an employer sponsors. Either way, the contribution is tested against the employee's annual allowance for the tax year in which it is paid, along with all other contributions paid by them or on their behalf. The total amount that is tested against the annual allowance is referred to as the total pension input amount. If this exceeds the annual allowance, a tax charge arises on the employee. Employees will, therefore, need to know the monetary value of the employer contributions that they benefit from. For a defined contribution scheme, this is simply the amount the employer pays in respect of that employee in the tax year. The value for a defined benefit scheme is more complicated and is not usually known until many months after the year ends. This is because the pension that has been built up over the tax year needs to be calculated by the scheme, and this figure then converts into its equivalent pension input amount. The latter part of this process should be familiar and is shown on the slide. In broad terms, it is 16 times the difference between the accrued pension at the end of the tax year and the start of the tax year, plus the value of any lump sum accrued during the same period and after adjusting for CPI inflation. Deducting the employee's own contribution to the scheme from this figure gives the employer contribution. We will now move on to the tax treatment of employer contributions, firstly from the employee's point of view and then from the employer's perspective, which is particularly important for those clients that run owner-managed businesses via a company structure. Employer contributions are paid gross and do not attract tax relief. They are, however, a tax-free benefit for the employee, which is equivalent to receiving tax relief. They are also exempt from national insurance contributions, whereas personal contributions are paid from earnings that suffered national insurance, which cannot be reclaimed. Furthermore, no national insurance contributions are due on employer contributions. This highly tax-efficient treatment ensures that employer pension contributions remain as popular as ever. It is also why many employees will enter into salary sacrifice agreements, which converts personal contributions to often more tax-efficient employer contributions. Employees should seriously consider the offer of pension salary sacrifice from their employer. The potential savings can be significant and can often be received either as an enhancement to the pension contribution or as an enhancement to the take-home pay. The potential saving to the employer also incentivizes them to set up such schemes. As well as promoting a tax-saving opportunity to their staff, they can also reduce their own national insurance bill. Advisors dealing with clients who run their own businesses will need to be familiar with the tax treatment of employer contributions from a business perspective, which we will move on to now. Businesses and companies benefit from paying employer contributions. The remuneration they pay to any staff is a deductible expense, which reduces taxable profits. The well-known wholly and exclusively test ensures that only genuine trade expenses can reduce profits for tax purposes, and this also applies to employer contributions. For employer contributions, this will rarely be an issue. An employee's remuneration package, including the employer contribution, will usually be deducted in full. However, there may be instances where the remuneration is excessive, and directors and their associates may come under closer scrutiny in this regard. And we'll have more on this in a moment. Owners of unincorporated businesses can pay employer contributions for any staff they employ and offset them against their profits for income tax purposes. They cannot, however, pay employer contributions for themselves due to their self-employed tax status. Consequently, sole traders and partners' pension funding is often restricted to their relevant UK earnings in the tax year. Owners of incorporated businesses can pay employer contributions for their staff and for themselves. Many one-person businesses would, in fact, have chosen to incorporate for tax reasons such as to be able to pay large employer contributions in excess of their earnings, and for other reasons including the ability to roll profits over without being subject to personal taxes. Total employer contributions paid in an accounting period are deductible from profits if they pass the wholly and exclusively test. This is also subject to the spreading rules, which we will not cover here. As we are approaching a 31st of March or 5th of April end of year, employers will need to ensure contributions that they intend to make in this accounting period are paid before the period ends to ensure a deduction from profits in the current period. As mentioned earlier, in most cases the full amount is deductible, which means employers will rarely have to consider whether there is a non-trade purpose for a pension contribution. And HMRC's Business Income Manual reassures employers on this point with the following two statements. Firstly, as part of the cost of employing staff, pension contributions are likely to be allowable. And secondly, a pension payment by an employer is normally wholly and exclusively for the purposes of its trade, even when the employees in respect of which the contribution is being made are retired or those of another employer. There are, however, some specific situations where corporation tax relief may not be available in full. Firstly, where the total remuneration package, not just the employer contribution, is excessive in relation to the duties carried out. Again, the Business Income Manual clarifies HMRC's approach with the following statement. One situation where all or part of a contribution may not have been paid wholly and exclusively for the purposes of the trade is where the level of the remuneration package is excessive for the value of the work undertaken by that individual for the employer. In this situation, you should consider whether the amount of the overall remuneration package, not simply the amount of the pension contribution, was paid wholly and exclusively for the purposes of the employer's trade. With this in mind, employer contributions paid to directors of close companies or friends and relatives of directors come under closer scrutiny than other contributions. To determine if the total remuneration package is excessive, it can be compared to that paid to other unconnected employees performing similar duties. If there is no comparable, then HMRC's guidance in Business Income Manual 47105 should be followed. These rules cover the scenario, for example, where a spouse is a director and has limited involvement with the company, but benefits from a very large employer contribution. Controlling directors, on the other hand, are rarely subject to a restriction when it comes to their overall remuneration package. They are usually the driving force behind the company and are responsible for the profits that it generates. Their remuneration package is therefore a commercial decision. Again, the Business Income Manual clarifies HMRC's approach with the following statement. Controlling directors are often the driving force behind the company. Where the controlling director is also the person whose work generates the company's income, then the level of the remuneration package is a commercial decision, and it is unlikely that there will be a non-trade purpose for the level of the remuneration package. It should be noted that remuneration does not include entitlement to dividends, etc., arising in the capacity of shareholder. One-person companies then should not have to consider whether an employer contribution is justifiable. They generate the company's profits and can pay any amount they like to themselves, but their contributions will be limited by the annual allowance. And finally, we'll look briefly at the annual allowance consequences. Provided that the money purchase annual allowance has not been triggered, the total pension input amount, including personal defined benefit accrual, is set against the standard or tapered annual allowance plus any available carry forward. If there is an annual allowance excess, a tax charge arises. The amount of tax payable depends on the individual's other income in the tax year, but will be charged at a minimum of 20% and is dealt with via self-assessment. The tax charge falls on the employee, even where an employer contribution caused the annual allowance excess. In some cases, depending on the amount of the tax charge and how much the member saved in each of their schemes, the charge may be paid out of the pension fund, which is known as scheme pays. Employees that will be subject to an annual allowance tax charge as a result of high levels of employer pension contribution may want to approach their employer and ask if it is possible to restructure their benefits. Some employers will be willing to help their employees avoid such a tax charge by, for example, paying additional salary instead of employer contributions that exceed the annual allowance. This can often be an issue for employees who are subject to the tapered or money purchase annual allowances. To conclude, Employer pension contributions are highly tax efficient for both the employee and the business or company. Employees will need to consider the total employer contributions they benefit from during the tax year and compare this with their available annual allowance plus carry forward and deal with any tax consequences that arise, or perhaps reduce their contribution before it leads to an excess above the annual allowance. Business owners will need to consider the rare circumstances where contributions are not always tax efficient. For example, they should check that they do not create adverse tax consequences via the annual allowance tax charge, that the contribution will be allowed as a deduction from profit, and that it is paid in the correct accounting period. Thank you for listening to this podcast. I hope I provided you with some useful insight into employer pension contributions and made you aware of the relevant and useful sections of HMRC's tax manuals to assist your own research. Please visit the Scottish Widows extranet and the Expertise tab to access further technical content such as textbook articles, CPD guides, and an extensive range of other support created by the financial planning team and other Scottish Widows experts. Or please contact your dedicated Scottish Widows representative for information on Scottish Widows products and support. Thank you.